let's think about the value of a stock. How do you value a stock? What's the value of a stock? The value of a stock, assume for now the investor holds investment forever. You buy the shares of a company, you never sell, you just hold it forever. How much do you pay? How much do you pay? Now obviously we're abstracting a bit because people die, right? And people die. So what's the meaning of holding stocks forever? In many cases, when people retire, maybe they want to sell their investment. But so we're abstracting a bit. Let's just say you have an investor that lives forever and he holds stocks forever. How much should he pay for the stock? What do you get? When you hold a stock and you never intend to sell, then you're in for the dividend, right? Because you're not going to get you're not going to gain from appreciation if you're not selling. So that means you have to be in for the dividend. With that in mind, you can view stock price as the net present value of future dividend, right? The price you pay today is the discounted future dividend stream. And it's not this still holds even if you sell your stocks, because if you sell your stock to someone else, presumably someone else has the same mindset. He's like holding the stocks for the dividend, and if the other person sells it to a third person, it's the same idea. So even though no one actually holds stocks forever, the idea still holds, because when you sell to someone else, then they're just paying the discounted value of a future dividend stream. So you can view the price of a stock as a discounted future stream of dividend. Right. So this is a very straightforward relationship here. Right. P equals to about the delta times d t plus 1 plus delta squared t plus 2 and so on and so forth. Do we see this relationship holding in reality? Yeah. So now this is perhaps the most famous diagram, in behavioral finance and perhaps even in the whole empirical finance. So this diagram was published in the American Economic Review in 1981 by Robert Shiller. This is kind of the diagram that won him his Nobel Prize. What do these two diagrams show? What they show is on the left-hand side is S&P 500, and the right-hand side is Dow Jones Industrial Average, so the two prevalent U.S. stock index. The solid line is the index itself, right? So this is the stock. This is S&P 500. It goes up and down, right, all the way back to 1870. As I said, if you want good daily stock price data online, it goes all the way. It just goes to 1970. But this paper was published in 1981. If you can actually go to the books and can find records of that if you need that. So for index, yeah, you do have data back to 1970s. So go up and down. You can see that you have the Great Depression, right? And the stock market crash before the Great Depression, oil crisis, and so on. Yeah, on the right-hand side is the Dow Jones Industrial Average, also up and down. So that's not surprising. Actual stock index do go up and down. We all know that. The dotted line is the interesting one. The dotted line is the exposed rational price, calculated based on the formula I've shown you just now. That is, we are now in 1981, right? We are in 1981. We have historical data on the stock market dividend rate, right? We have the benefit of hindsight. So we know how much dividend had been paid in the past. Using those dividend data, you can use the formula in the previous page, calculate the discount present net discount, like the discounted net present value, right? You can calculate net present value. And if you calculate net present value, you will see that net present value is actually very stable. It's actually quite stable compared to the actual index. So the question is, how do you justify the wide fluctuation in stock market when the future stream of income that the stock price are supposed to represent do not actually fluctuate that much? If you actually read financial statements, then this should not be too surprised to you, because a lot of companies do, for companies that do pay dividend is usually quite stable. In fact, for many people, the reason why they want to buy dividend paying stocks is that their dividend is stable. Like if you're in Hong Kong, if you buy CLP, the utility company for Kowloon and New Territories, they pretty much always pay 5% every year. That's kind of why people buy it. And what this diagram says is that for the whole stock market as a whole, that's pretty much true. Dividend is quite stable over the years. But dividend is quite stable over the years. So that means that price should also be very stable over the years if you follow the formula from the previous page. The price is the net present value of future dividend stream. This future dividend stream is stable. That means that the net present value should be stable. But that's not what we see. Net present value, the stock index, the actual stock index is very volatile. So in two diagrams, really it's just one diagram, right? Because it's just two indexes. So in one diagram, Shiller raised basically the most fundamental question in behavioral finance. Is this rational? Is stock price rational? Dividend stable, stock price is not. A lot of effort in finance involve trying to explain what's happening. Now, you can take a sort of what we would call a behavioral view. So you can say this is evidence that that stock market is not rational. Investors are somehow overvaluing stocks and at some point and undervaluing stocks at other points. So that's one way you can say it, right? This is evidence that stock market is irrational. It just goes up and down for reasons other than the underlying value. That's one. But there are also efforts in the rational camp to try to explain. So that's something that that's more complicated to talk about. So we will leave it to a later time, probably. So we first think about the irrational side first, because irrational side is actually easier to understand. So investors somehow have some sort of swing in their evaluation, and what might be driving those? And since Shiller's paper, there have been a lot of research looking into various factors that affect stock price that you might not have thought about. So I've talked about all those already. Okay, so actual stock price or did it stop somehow for a while? Never mind. Let's just move forward to the next slide. All right. So the anomaly is stock price is more volatile than dividend. So, and we have already explained why it's problematic. Why it's problematic because ultimately from a theoretical perspective, stock price should be a net present value of the discounted future stream of dividend. So, as I said, in the years since then, we have actually a lot of studies that show how factors that you might not have thought should affect stock price actually do affect stock price. So the first one, turns out the stock that you can get, you can find abnormal return when the sky is cloudy. Have you ever thought of that? Stock market return is going to be abnormal when you have cloudy skies. So first, you need a measure of cloudiness. So we have that as case. So you can find that pretty easily, right? Just go on to like weather.com, right? You can get weather information all over the world. So that's not difficult. We have that. Then you can put that into a ORS regression, right? You have stock returns that you can find either from WRDS or you can find it or from Yahoo Finance. You put it in an ORS regression, see if when the sky is cloudy, whether the stock return is particularly high or low. If you want to be more sophisticated, then you can try to control for other factors, but this is basically the idea, right? Just regress stock return on cloudiness, right? So these are coefficients for various places in the world, and those with a star are the ones that that are statistically significant. So if you just look at individual cities, like here, right? You have all these individual cities with stock market, like Amsterdam, New York, Stockholm, London, and so on. If you just look at individual cities, well, very few of them actually by themselves have a significant correlation with weather. So, but you can see that most of them are negative, right? You can see a lot of them, none of the numbers are negative, suggesting that the stock market goes down when the weather is cloudy. So pull all the cities together, and do the regression again, and the overall effect is significant. The overall effect is quite small. It's like 1%. Like it's very small effect, but it's on average it's there, and it's statistically significant. T-stat is something like 4.49, so it's quite significant. So overall, if you look at the whole world, when the weather is bad, stock price goes down, right? So this is the ORS regression. You can also use the logit regression, right, which just looks at the direction instead of the actual magnitude, and you should pretty much get the same thing. There's a negative effect, which is statistically significant, right? So so I've described that, right? So this is looking at the chance, right? This is looking at the chance. One thing that I want to note is this is logit. So this is a logit model. It's looking at the probability of things moving up and down. Now the author is reporting the logit coefficient. The logit coefficient by itself is very hard to interpret, other than positive or negative. So that's why I'm just emphasizing that it's negative. That means that stock return is unlikely. Stock return is unlikely to be positive when it's cloudy. It's from this coefficient, it's pretty much impossible for you to interpret how large the effect is. So that's why I won't emphasize on the size from this one, right? But it's small chance of going up. Okay, so bad weather, poor stock return. Next, daylight saving clock change. Now in Hong Kong, we don't have daylight saving. I'll say that's actually a really good idea. People hate daylight saving time. I think daylight saving is a time change used in some Western countries, like in the United States, where you turn the clock forward and backward depending on whether it's summer or winter. The idea is that in the past, when you don't have electricity, you need to conserve candle lights. So you need to move the clock back and forth with the sun, right? When the sun, in the winter, when the sun like have shorter duration, then you turn the clock to fit that. These days you have electricity, so it's kind of weird idea to do that anymore. But like, efforts to eliminate daylight saving in the United States seems to have gone nowhere. So, in any way, in the United States today, you still have to fast forward your clock once and then move the clock back an hour once every year, right? So that's something you just have to do. And so what happens in those occasions? Right. So look at this study. This study, Losing Sleep at the Market, the Daylight Saving Anomaly, published in AER, looks at what happens to the stock market return when on the day of switching. So you have the spring where you have the switch, right? So it's negative. So it's basically negative across the board, right? So no matter where you're looking for, New York Stock Exchange, AMEX, Nasdaq, S&P 500, whatever you're looking at is all negative, right? Similarly, if you look at when you have to move the clock back, it's also negative. So whenever you switch the clock, stock market return is particularly low. Just to make sure that it's not something that is like a general trend. If you look at the average of any other days that it does not involve switching the clock, it's just pretty much it's slightly positive, right? Reflecting the stock market generally goes up, so it's slightly positive. If you look at weekend, across the weekend is slightly negative. So when you go from a Friday to a Monday, usually it's going to be negative. But it's talking about like 0.0007 effect. This is very small effect. So it's in contrast, the daylight saving effect is like a magnitude of 10 figure, right? So these are like the weekend effect is negative 0.0007. The fall adjustment has a negative 0.006. So that's like 10 times bigger. You can run a joint t-test whether the daylight saving effect is statistically significant, and it is statistically significant. The t-stack is like way bigger than 2, right? So it is statistically significant. Okay, so when you adjust the clock, stock market on average goes down. Stock market on average goes down. All right. Next one. What about soccer matches, like the World Cup? What happens to the stock market after an important soccer match? Once again, it's the same idea, right? You have a data set, or you just collect the dates of soccer matches, run an OLS regression on a dummy variable indicating there's a soccer match. We'll see what's the coefficient. So that's the regression you run, right? So this is in this particular paper. So this is a spot settlement and stock returns published in Journal of Finance. So they ran it like a Yes. There are actually two papers. One looks at what happens when your country team lost. So one look at how your stock market reacts to your country team losing, right? So like when the Argentinian team lost, what happens to Argentinian stock market? So that's one paper. There's another paper that looks at just the effect of any soccer match, regardless of which side win, on the U.S. stock market, based on the premise that the U.S. stock market is the biggest in the world and it's invested by investors from all over the world. So there are two papers actually. Right. So this study. So what did it do? This one is the one I think this one is the one that looks at the U.S. stock market. This one is the one that looks at the U.S. stock market. So, but there was another one that looks at what happens when your home team, when your country team lost too. So you regress the return. This is an ORS regression. You regress the return on anything that you can think should explain return, right? Past return, date, like time of year, whatever you want. Just first put in everything that you think should explain stock price. Run a regression, find the residual, S1. So the residual is the residual return that you can't explain with all the factors that you think should explain stock return. And then you regress the residual on this is win-loss. So this is actually the one with home country. This is the one with home country, sorry. So you regress the residual on an indicator whether your home team win, and an indicator of whether your home team lost. Yeah. Right. So otherwise it doesn't make sense, right? Because there's always a team winning and a team losing. So this is the one for each country, right? So yeah. So so they use this two-stage process. I think you should get a similar result even if you don't do a two-stage result. You can just put everything in. I think it should still work fine. So in any case, under this method, you can see that when your country team wins, in an international soccer match, in most cases the stock market goes up, right? Stock market goes up, but the t values are very small. Similarly, when your country team loses, the coefficients are mostly negative, so stock market goes down. And the t-stacks are more significant. In particular, if you pool all games together, then the t-stack is significant. It's negative 3.27, right? So it seems like if your home country team loses in an international soccer match, on average, your stock market does go down, right? So is this just something that happens with soccer? Right. So I've already talked about that. Is this something that just happens with soccer? No. So this paper also looked at cricket, rugby, hockey, basketball, you name it, they try it. So same idea as before. And once again, what you have is winning. Winning doesn't really have much effect. In this case, in fact, you can see some negative numbers, but they're not statistically significant. Winning doesn't really have much effect, but losing have statistically significant negative effect. However, notice that for cricket, rugby, ice hockey, and basketball, you have to pool all these sports together in order to get statistical significance, except for basketball. Basketball itself is quite significant. For the other ones, they're not by themselves, they're not significant. So you have to pool all of them together, then you get statistically significance, right? So that's telling you the effect is very small. The effect is very small, but if you have enough data, you can see that there seems to be a systematic pattern. Right. The authors also try to use a portfolio approach, right? What's the return of buying winning countries versus buying losing countries, right? Now, this obviously means you have to do. This is only possible after the match, right? Unless you have foresight, or you have actually bribed the players. Otherwise, you won't be able to tell which team necessarily win in a competitive match. If it's something like Brazil versus Hong Kong, then it's easy. But then I don't think there's going to be a very strong effect, because everyone expects Hong Kong to lose. So that probably is not going to work. So imagine that you buy the stock market index in the country that won the last match, and sell the stock market index of the country that loses that lost the last match, right? That lost the last match. Well, what do you see? Right. So once again, so if you buy the winning team, it's pretty much do nothing. It's a slightly negative coefficient, but it's not statistically significant. So you can't really say that you can lose money, but the point estimate is negative, so you're not gaining any money. If you buy the losing team, once again, it's negative, but then it's not statistically significant either. So basically, there's not much effect going on here. All the numbers are too small to make any difference. So it's not a very profitable strategy. The effect exists, but it's so small that it's probably not something that you can easily exploit. Which is why there's the next paper that I mentioned, because it's so hard to because it's hard to exploit the effect after the fact. Basically, in most of these anomalies, you have to have foresight in order to take advantage of them. After the match has resolved, and then there's not much information in following the match result anymore. That's why that's the next paper, where there's a follow-up paper that just looks into, well, what happens to the stock market, the U.S. stock market on average after a soccer match, and on average the U.S. stock market goes down after a soccer match. So that's something you can exploit, because if you know there's a stock market, if you know there's an important soccer match coming up, theoretically, if you short sell the market, you should be able to earn a profit. So that's the idea, because the stock market on average goes down after a soccer match, regardless of who wins in the US, right? So if you short sell the US market after any soccer match, it seems on average you should be able to make a profit. That's the idea. But for us, the focus is not so much on whether you can make money out of it, but for us, the question is, what do you think is happening? When the weather is bad, stock market goes down on average. When you change the clock, stock market goes down on average. When there's a soccer match, stock market goes down on average. What do you think is happening? What do you think is in common among these three examples? Think about it, right? So, how do you feel when the weather is bad, like it's raining all day long? How do you feel? You probably feel gloomy, right? But you probably don't, unless you are among the minority who actually likes raining. Most of the time, when it rains, people feel kind of bad, right? So what about changing the clock? If I force you to wake up an hour early than usual, how do you feel? Ugh, right? I think about it, right? No one likes morning class. So forcing people to wake up early is something that people hate a lot. You might even just feel bad for the whole day long if I force you to wake up earlier than usual, right? People feel bad about when you change the clock. Soccer match. What happens during soccer match? Now, first, it's understandably if your home team lost the match, then you probably feel pretty bad the day afterwards, right? If you are a soccer fan, I would say if you're in a general, if you use gender stereotype, right? I mean, guys like soccer, and finance is a very male-dominant field. So yeah. So people probably hate it. Furthermore, there's one explanation why the stock market generally goes down when there's a soccer match. Besides the fact that you might feel bad if your team lost the day previously. Well, the thing is, especially in places like Hong Kong, soccer matches don't take place. Soccer matches very often take place in the middle of night, right? Because of time zone reasons, right? In Hong Kong, you are 8 hours ahead of London. US is something like US is like 5 hours behind London, right? Something like so. Because of time difference, very often the important soccer matches are played at a time when you're supposed to be sleeping or working, right? So now it's basically you get distracted, right? You either do not have enough sleep and you feel really bad the day after, or you probably just not working, right? Both of those might affect stock market return, right? If you're in a bad mood, you're probably not going to buy. You're not going to have a very positive view of the stock market that day. So it's the same idea. It's like people's feeling seems to have an effect on stock market. All these studies are looking into factors that affect people's feelings, and it seems like people's feelings do affect stock market. Right. So having used stock market index as the target of study, now let's switch to microdata using the Terra Nordin's discount brokerage data that we have seen before when we look into a disposition effect. So what did he do? So this is actually using Odin's data, but it's not one of Odin's paper. This is Odin's data, but not a paper published by Terence Odin. It's a paper published by someone else using his data, right? So the idea is, okay, you have the trading pattern from Terence Odin's data. You know how much you know what stock the small investor purchased. You know what stock they sell and so on. So you're going to form 1,000 random non-overlapping portfolios of stock, right? So you just basically like randomly draw from the actual trading records, right? You randomly draw from the actual trading records to simulate an investment portfolio. Right. So now we're going to calculate an index called buy-sell imbalance. So it's the money buying minus money selling over the overall trading volume, or the overall trading volume, right? So money buying minus money selling over the overall trading volume. So that's much. So how much more money is spent in buying versus the money spent in selling, right? Right. So we're going to look into the correlation across the different portfolios, across the different portfolios, right? So what this looking at is this. In a portfolio, you have different stocks, right? If you're just buying one stock, you usually don't call that a portfolio. What we are doing is we are randomly forming portfolio based on actual trading records. So, for example, in this case, I randomly draw two trading records. One trading record purchase HSBC. The other trading record purchase Microsoft. Right? Let's just take two. Let's use two as the example, right? So I randomly draw some trading records based on actual data, and I happen to draw upon HSBC and Microsoft. So this is my portfolio based on actual data. So I calculate the buy-sell imbalance for HSBC and Microsoft in this portfolio based on the actual trading record. What's the correlation between these two BSI index, for one for Microsoft and one for HSBC, right? What you see is that there's very high correlation. That is, when you if in this randomly formed portfolio, the record shows that the investor has purchased more HSBC than he sell, then chances are you're also going to see more purchase in Microsoft than the amounts sold, right? So that's the correlation here. If you see investor investing in one stock, then you're very likely to see investor investing in another stock. If you see an investor selling one stock, you're likely to see the investor selling another stock, right? So that's why there's a correlation. Even though we are randomly drawing data out of the trading records, you still find correlation between the different records. When there's a buy in one record, there's likely to be a buy in another record. So that's what this is looking at. So the authors didn't even really bother to show any negative correlation. So it suggests that the most of the data is positive. So when investors buy, they tend to buy all other stocks too. That's what it's saying. If the investors are buying this particular stock, they tend to be buying all other stocks. If the investor is selling this particular stock that you have randomly drawn from data, they're likely to be selling any other stock that you might be able to draw upon. When you buy everything. When you sell everything. So that's what this paper is trying to say. And this correlation has predictive power. Now, this paper was published in the Journal of Finance. It has to be, Journal of Finance has like a 99% rejection rate. So it has to be a pretty, you basically have to show that the effect is very strong in order to publish in Journal of Finance. So as I said before, when we talk about Feynman French, the standard practice these days in empirical finance is you have to show that your anomaly holds after controlling for beta, Feynman French, momentum. So you have to show that your anomaly still exists after you control for these four factors. And so in this case, does the correlation have predictive power? Does the correlation have predictive power? In other words, if you find that there's very high correlation, between different stock trades at this moment, right? So now, how do you get this data? You probably have to be working in a brokerage to get to such data in real time, right? So let's say you are a trader in a brokerage firm. You look at the data your company has at the moment. You notice that your clients are buying. Your clients are all buying, right? So there's a very high correlation, right? Using that fact, can you make a profitable trade out of it? And the answer is yes. The answer is yes. The answer is yes. Let's see. Yes. I forget to mention what. Yeah, never mind. Right. The answer is yes. When you see particularly high correlation between different trading behaviors, that is actually capable of predicting stock return. That's actually capable of predicting stock return. I don't quite remember why. Because I don't quite remember. I think what you have in the first 4 years. So they sort into five. Divide the stocks into 5 groups based on size, right? Divide stocks into 5 groups based on size. Small to big. When you see very high correlation among investors' buying and selling behavior, does it have predictive power? Yes, for small stocks, which is yes for small stocks and not for big stocks, right? So this is not something surprising by now. For big stocks, typically the market is very efficient, so a lot of these anomalies do not work with big stocks. But for small stocks, when you see that small investors are buying, then it is predictive. All right. So once again, what do you think is happening? How do you explain what's happening, right? What do you think is happening? So when you see investors in a buying, like basically in a shopping trip, right? You see investors buying up different things. What can you deduce? From their behavior? We're not talking about buying a single stock because we're looking at the correlation between different trades, right? We're talking about investors buying many things. We're not talking about investing buying one thing. We're talking about investor you observe that investors are buying many different stocks and they're not selling anything. What can you deduce from that behavior? Now, let's not think about stocks. Let's not think about stock market, right? Let's think about, let's say you go out, you see a friend, and you see your friend holding like 10 bags of 10 bags of stuff she purchased in a shopping mall. What would you say? Wow, you're in a really good mood. Exactly, right? It's the same idea. When you see investors buying like 10 stocks and not selling anything, that's not portfolio rebalancing, right? They're kind of having a really good mood. So what the interpretation in this paper is that when you see very high correlation between investors' trading behavior, they're buying things, they're not selling anything, they're not rebalancing their portfolio. They're in a good mood, right? So that's in some sense capturing the sentiment, their feeling. So, and what this says is that their feeling, their sentiment has predictive power. So the stock market is affected by investor sentiment. Right. Finally, so I have one more example before we think about how to explain that theoretically. So there's one more example. So this one is just this is basically the idea of going on a shopping spree. Like you have investor buying all these stocks, not selling anything. They must be really happy. Or in contrast, if you've seen them selling everything, not buying anything, then they probably think they are kind of having a bad mood. And we're talking about general market sentiment here. If you want, since we are observing it. Finally, there's one more study that I want to talk about. Is this closed-end fund puzzle. So there are two types of mutual funds: closed-end funds and open-end funds. Both of these mutual funds invest in publicly traded assets, like buying stocks, basically. So they're not doing private equity; they're investing in stocks. The difference between open-ended fund and closed-end fund is that open-ended fund you can redeem the net asset value from the funds, right? You have one share of the fund. You can bring the share to the fund, and then you can redeem for the underlying asset. Well, probably not they don't actually give you underlying asset, but rather they just pay you the value of the underlying asset. For closed-end fund, you can't redeem it that way. You can it's only redeemable at liquidation. Now you can sell your share to someone else, but you can't redeem the net asset value. The difference is so basically the idea is I set up this fund. I say I have like 100,000 shares. I have 100,000 shares. Who wants to buy it? You buy it. You take it. You can't bring it back to me. What you can do is you can trade on exchanges. You can sell it to someone else, but you can't bring it back to me unless I liquidate my fund. So this makes a big difference when the market value and the net asset value diverge, right? For example, let's just say I manage a mutual fund. I manage a mutual fund that only owns HSBC. Now, HSBC has a market value per share of something like $60. And let's say, for some reason, the value of my fund is just like $50, right? So the net asset value is 60, but my fund is only worth 50. So there's a huge discount for some reason. In an open-ended fund, you certainly do not want to sell my shares to someone else, because that will only fetch you 50. Rather, you would very much want to bring your share to me and redeem it for the net asset value of $60. That you can do for open-ended funds, but you can't do it for closed-end funds. For closed-end funds, you just tough luck. You have to decide from someone else. Right? So the closed-end fund puzzle is the fact that closed-end fund shares typically sell at prices different from their net asset value, right? So the thing is, they do actually differ. And why? The question is why? If my fund only hold HSBC, why shouldn't my fund has the same value as HSBC, the underlying HSBC shares that I hold? Why would it be different? The difference is usually a discount. As I said, if I hold HSBC shares, if HSBC shares is $60 each, my fund would probably only worth 55, something like that. Why? So here are the pieces of the puzzle. When a closed-end fund start out, it's usually close to NAV. So when I establish my fund, I told you that I'm going to buy HSBC at $60. Then most of the time, the shares of my mutual fund do trade at $60, close, like 59 maybe. But after about 3 months, closed-end fund moved to an average discount of over 10%. So now it goes from $60 to $54, even though my underlying asset still worth $60. So there's a discount. So here's this table shows the discount of closed-end funds for different types of closed-end funds. So remember, closed-end funds are type of funds that you cannot redeem the net asset value. So you cannot easily arbitrage the difference. And the discount is discount in the 90 days is in the very bottom column. On average, closed-end funds have a 12.91% discount. Bond fund 6% discount. U.S. stock fund 20% discount. Foreign stock funds 14% discount. Right. So this is index adjust, right? So this is relative to the index, relative to stock index. So that means what that means is if you spend $100 buying let's say Hang Seng Index or S&P 500, you spend $100 buying Hang Seng Index, and you spend $100 buying a closed-end fund. 90 days later, the closed-end fund would be 14% on average. On average, 12.9% lower than the Hang Seng Index. If you buy just stocks, though, it's 19% lower. So it seems like a dumb idea. Like, why would anyone do that? But that's what the data shows. So price goes down relative to net asset value, right? We're talking about the net asset value. The discount fluctuates widely. It's not like it's a stable discount. The discount actually fluctuates a lot, ranging from depending on which year that you're looking at. Now, the average, there's always a discount, right? It's almost always big. The discount is almost always larger than zero. There's always a discount. But the discount ranges anywhere from 25% to almost nothing. So sometimes investors really hate these type of closed-end funds, and they discount it by a lot. Sometimes they seem okay about it. Finally, now what happens if your closed-end fund actually liquidates, right? If a closed-end fund actually liquidates, like So that happens from time to time. So I decide I'm going to fold my fund. I'm not going to manage it any longer. When I make that decision, I would tell everyone, all my investors, you can redeem the underlying asset. You can redeem the money worth to you, right? The money I owe to you. So just bring back your shares. I pay you back based on the underlying asset value, the underlying net asset value. And when that happens, the discount shrinks. Which is understandable, right? Because I've already told you that you can redeem. So if the underlying asset, if the shares of the closed-end fund still sell at a discount, there will be an arbitrage opportunity. You just buy it at a discount, bring it immediately to me to redeem. So it's understandable that if the fund decides to liquidate, when you can actually redeem the net asset value, then there should be no discount, and that's the case. There is no discount. So these are 6 examples of closed-end funds liquidating or open-ending. So they decide to switch to an open-ended fund. Well, right? So in most cases you can see that the discount goes down. It's not really clean effect. It's not the case where when you announce that you're going to open end, it's going to be an immediate straight drop to zero in discount. There's still some discount, but it's gradually decreasing in most cases. Right. So if you take a look in the reference underneath each slide, if you take a reference underneath each slide, you can see that these are actually show you data from 3 papers already. 3 papers. So from these 3 papers, that's the pieces of evidence we have, and we want to explain how come a mutual fund could worth less than its underlying asset. That's the question we need to answer. How can a mutual fund worth less than the asset it actually holds? Right. So we're going to go through a few standard explanations. Now, the first question that we might want to ask is whether it's agency costs. Could it be management fees being too high, or poor management, right? So in some sense, it's like, yeah, I don't really trust the managers. They charge me a lot. They're not giving me high. They're probably not picking the right stocks, so I'm discounting them. Now, what's the problem with this explanation? Let's think about it. Okay. If this is the case, first, why is there a difference between open-ended fund and closed-ended fund? That's one question you have to ask, right? You also, and then you've got, why is the discount fluctuating by so much, given that it's managed by the same people? A fund is usually managed by the same. The fund is often managed by the same people for a long time. So why would there be fluctuations? It can't really explain if it's agency cost. It doesn't seem to make sense that it should fluctuate so much. Sometimes like up to 20% discount, sometimes as low as 1% discount. So why would there be fluctuations? Is it because of the liquidity of assets? Because you can't redeem the net asset value? Is that because the case? Now the stock by themselves, the underlying assets are not really illiquid, right? The illiquidity would come from the fact that you can't redeem the net asset value. there's a possibility of the following. You assign a discount to the mutual fund because because you're worried that when the fund actually folds, when the fund liquidates, yes, it has to sell all its assets in order to repay its investor. And you as an investor might worry that if the fund is large enough, it would be market moving. So when the fund liquidates, it's going to drive down the value of all the stocks it holds, right? If I'm a big investor of a small stock, when I liquidate my fund, I sell all my shares of that particular small stock. That's probably going to drive the price of that stock very low. That might be a worry. So that's why you assign a discount to the stock. Because as an investor, you worry that the day of liquidation is going to push the stock price a lot lower than the current market price. The problem with this explanation is, based on the actual records, we see that when a fund actually liquidates, discount goes down, not up, right? When a fund actually announce that they're going to liquidate, investors kind of rejoice. They're not becoming more depressed. So it doesn't seem like the story is the reason behind. Investors are not worrying that the closed-end fund is going to liquidate. In fact, they really like liquidation because they can get back the money, it seems. So that doesn't seem to be a reason. And then there's tax liability. There's tax liability because when this fund liquidates, you get back your money, you have to pay tax, right? So that's even though if I'm holding $60 worth of HSBC, it's not going to worth $60 to you because when I liquidate, then you get back the money, you have to pay tax, capital gains tax. So you say that, okay, in the US, capital gains tax is like 15%. So you have to discount the stock price, discount the value of the shares because you're going to have to pay tax. But once again, in that case, why would the value of a closed-end fund goes up when a liquidation is actually announced? Right? If you worry about paying tax, why would you actually want to buy more shares when the fund is actually going to liquidate? So that's why it's a puzzle. That's why it's a puzzle. It doesn't seem like any of these explanations would explain why a closed-end fund would have a discount, because people are quite happy when the fund liquidates. So it has something to do with the fact that you can't redeem the underlying net asset value. You can't redeem the net asset value because if you can, then there seems to be no problem. Right. So the explanation once again is maybe it has something to do with investors' sentiment. Maybe. Well, so maybe it has to do with the fact that there are some irrational investors. There are some irrational noise traders. They're irrational. They have basically wide fluctuations in their valuations. So we're going to talk about this model after the break, the DeLong, etc., 1990 model. And we're going to utilize this model to explain why closed-end fund might have a discount. But the idea is closed-end funds have a higher fraction of individual clients than overall market. So institutional investors don't buy closed-end funds. Small investors do. The small investors are less rational, right? So the idea is you have these closed-end funds are purchased by small investors. Small investors are irrational. When they're irrational, they do stupid things. When they do stupid things, the stock is risky. When the stock is risky, then it has a discount, right? Because you don't, all else equal, you don't want to buy something risky. So that's the idea, right? So that's the idea. These closed-end funds are purchased by small investors. Small investors are dumb. Dumb people do stupid things, making the stock risky. So they sell at a discount. The stock sell at a discount because people don't like it, right? So that's the idea. And we're going to talk about the model. Yeah, we're going to talk about model after the break. So let's take a break now. We're going to talk about the model. So we'll come back at something like 5 minutes past 12. Right. So now that we covered the model, how does the model help us explain the closed-end fund puzzle? How does the model help us explain the closed-end fund puzzle? Remember, so now the closed-end fund puzzle is that closed-end fund, which are funds that you cannot redeem the net asset value directly from the fund itself. So you can sell your shares, of the fund, but you cannot redeem the underlying value. They trade at a discount. They trade at a discount. And how does noise trader risk help us explain this? Okay, so closed-end funds have a higher fraction of individual clients in the overall market. So that's something that we know. They have a higher fraction of individual clients than overall market. Like as in in an actual financial market, so like Hong Kong or more so in New York, the market, most of the assets are held and traded by institutional traders. Like, because most individuals, you don't actually have that much money to buy stocks yourself. Most of the time, your holdings are part of, say, your pension fund, your MPF, right? And MPF is managed by a professionals. So most of the assets in a financial market are traded by institutional traders. Institutional traders don't really trade in closed-end funds because, if anything, why don't you just buy the underlying asset yourself, right? If you are a big investor, if you're HSBC, if you're Goldman Sachs, you can buy the underlying asset yourself. There's no need for you to invest in a closed-end fund that you cannot redeem the underlying assets. Why not just do it yourself? So these type of funds are typically purchased by small individual investors. Now, let's just assume that they're less rational, right? We're just going to assume individual investors are noise traders, but we do have quite a bit of evidence throughout the term, right? They are more likely to buy than sell at a loss. We know that they are affected by weather. They are affected by soccer matches. They were affected by clock change. I think it's fair to assume that they're not completely rational. So the idea is you have these investors who like to purchase closed-end funds, and because they're noise traders, they're not very rational. Sometimes they're very optimistic, sometimes they're pessimistic. They introduce risk into the closed-end fund. Risk, lower price. That's a discount. The question is why it's not arbitrage away. Well, it's not arbitrage away because you cannot redeem the net asset value. That's the problem. In open-ended funds, it doesn't matter that small investors like your open-ended fund. You can redeem the net asset value. So if you see that these investors are really, really happy, but if you see these investors are really really happy about this open-end fund, and if you hold some shares of that, sell to them, take the money, buy the underlying assets yourself. So in open-ended funds where you can redeem the net asset value, you can arbitrage, but not in closed-end funds because you can't redeem the underlying value. Even if you know that the investors buying the closed-end funds are mispricing, it's not possible for you as a rational investor to arbitrage the difference. Right. So overall, the four part of the puzzle of the closed-end fund. Why do they have a discount? Why do they have a discount? Why do they sell at a discount? They sell at a discount because of the risks introduced by these small investors. They just have random fluctuations in their valuations. The initial high valuation can be explained by a market timing model, right? So if you know your clientele, you know your clients are your clients sometimes are very optimistic. They sometimes are very pessimistic, and you're trying to sell a product to your client. Do you want to sell your product to your client when he's optimistic, or do you want to sell your product to your client when he's pessimistic? Obviously, you want to sell your product when he's optimistic, right? When he's optimistic, he's willing to pay a high price. And as a rational fund manager, you should time the market. You should time the market. You should not just randomly start a fund. You should start a fund when the market is optimistic. So the wide fluctuation in discount that we have seen is due to the fluctuation in sentiment. So the investors are sometimes optimistic, sometimes pessimistic. And the shrinkage of discount when the closed-end fund terminates is because arbitrage is possible. You can redeem the net asset value. So what evidence do we have of that? If you look at the closed-end funds, so these are some sample close. These are these are closed-end funds, and these are correlations. And if you look at the numbers, the correlations are actually very high among themselves. The correlation among each closed-end fund is all positive and quite high. But if you correlate them with like the overall NYSE NYSE, the correlation is zero. The closed-end funds have no correlation with NYSE, pretty much. They're very correlated among themselves, but they are not correlated with the performance of the New York Stock Exchange as a whole. So that tells you that the clientele is probably different, not the same customers, because the price fluctuations have no correlation. Right. So that's why. So it seems like the closed-end funds are very similar to each other, but very different from the overall market. Market timing. So the line represents discount. The bar represents the number of closed-end funds being started, and you can see very clearly that when discount is low, in fact, when discount is negative, that is, there is a premium in the closed-end funds. People are willing to pay more than the underlying assets. Then you have a whole bunch of funds starting. Fund managers are smart people. Fund managers, they understand that they should time the market. You don't want to start a fund when people are discounting your fund by 20%. You start a fund when people are willing to pay you a premium. So you see a whole bunch of funds started when the discount is low. And similarly at the end here, right? So market timing is something we talk about when we come back from the break. I think we have a break. We have a holiday next week. So market timing is something that is very prevalent in finance. Funds get started when people are willing to pay for it. And that also means that most of the time, you can expect a somewhat negative return after a while from these funds because of market timing. If you think about it, it's actually in Hong Kong, this is actually very prevalent, although it's not necessarily for the same reason. But in Hong Kong, new stock listings typically go up by a lot in the first 2 days, then crash for the next month, right? So same idea. You go public. You go public when people like your shares, but then subsequently that also usually means that your performance is going to be low. Finally, what's the correlation between the performance of these closed-end funds and different size of the market, so small cap to large cap, right? So this is just ORS regressing the returns of different size decile of stocks into the change in discount of the closed-end funds. And the coefficient, as you see, for small stocks, you have a significantly negative relationship with the change in discount. And for large stocks, you actually have a positive relationship. How do you interpret that? So change in discount. Remember, because discount is usually the bigger the discount means that that means that the investors are not optimistic, right? Because discount means people don't like your fund. They discount your fund. Large discount means people are not optimistic. Small discount means people are optimistic. So when people are becoming less optimistic, small stocks have lower return. When people are becoming less optimistic, large stocks have higher return, which is consistent with the story of individual investors, right? You have these these closed-end funds are traded by people where